Welcome to Wall Street Confidential. I'm Farnoosh Torabi. I want to welcome Jim Cramer to the show. Hi, Jim. Topping headlines this morning, earnings headlines, Toll Brothers, they actually made money in their third quarter. And yesterday we were talking about some home builders that might be worth investing in. You mentioned Toll, but the earnings report kind of confuses me, and I think a lot of investors are still not sure if they're really an outlier among all the other home builders.
Well, first, I just did a piece for RealMoney.com about the notion of what is happening with Toll Brothers. Once the Fed changes and starts cutting, the psychology, it gives Toll the benefit of the doubt. There's no doubt in my mind that if the Fed hadn't cut, in this case with the discount rate cut, you would want to sell Toll. I recommended Toll yesterday simply because of the Fed, because frankly there's really nothing that's good in the report. They made the number, and this is one of the things that I've seen over and over again with housing, but you don't know whether there's going to be houses that they sold that come back. Also, this quarter did not take into account Thornburg Mortgage, was very important. Because it's jumbo mortgages, it didn't take into account Countrywide moving out of the origination game that would be typically at the Toll level. So it really was an unimportant quarter. But you could say that they really didn't make money if things don't go right because of the fungibility of what I regard as being housing companies' earnings. Their balance sheet's okay. They will make it, I believe. But you have to recognize that this is a very heavily shorted group, and other than a totally disastrous quarter, this was a very good risk-reward situation.
In terms of, you mentioned very appropriately, like companies like Land and CFC and TMA, that wasn't accounted for in that report. Do you think we have to look closer to the fourth quarter results?
Yeah, yes, and I also feel like that there's a lot of confusion here. On the previous conference call, Bob Toll, a man I have tremendous respect for, said that very few of their loans were of the no-doc, low-doc nature. Bank of America came out yesterday and said 43% are no-doc, low-doc. Now, when you get that kind of differential, you begin to wonder, well, what's really going on? Now, it's entirely possible what's happening is, and I think this is going to be the next battleground, is the second lien. A lot of people bought homes and then immediately did a home equity loan on the home. That would be virtual when you add up the mortgage and the home equity loan to come to 125% of the value of a house, because the house is supposed to improve in value. Now, they haven't. They've been going down. I've been looking at a bunch of them, including Beazer. And what it tells me is that it's entirely possible that Bob Toll could be right, that initially the loan is a good loan. But then when you put a home equity loan on top of it, then suddenly you have a bad loan. So I look at Toll Brothers and I say the psychology's changed. It could continue to go higher if we get the cut. If we don't get the cut, then you'll have to sell the stock very quickly.
Okay, and finally, just to as an aside, a random using D.R. Horton. I've done a little bit of homework on them, but I want to ask you, what should I be really looking at? But here's what I found and why I think it might be positive. They're saying that by the end of this year, they're going to have $1 billion in cash in reserve to pay off their debt and the dividend. The company is trading around 0.9 times book value, which isn't exceptional. I mean, most of the home builders are doing that as well.
Because the book is phony.
Oh, okay. So, how do you evaluate the book?
Well, I mean, the book. When I say the book is phony, I mean, no one ever wants to hear that a book is phony. What I just say is it hasn't been written down yet. It would be probably more politic to say that the book could be impaired. I try to be a little more emphatic in a Wall Street Confidential. All it does is get me in trouble, but it's the way people talk off the desk, and that's what I try to do. And D.R. Horton, like many of the home builders, made a series of acquisitions and options in 2005, 2006 that is forcing them to continue to build. What you want to find out with Horton, which is what I was able to come up with why I like Centex, is that versus the rest of the group, is that what you'll see is if they're no longer building, if they're making far fewer homes, and I believe Horton is, but I haven't checked it as of the last quarter it was, then you know that they're winding down, they're willy-nilly building. What's happened with home builders is they'll have committed to building a community, and they'll put the infrastructure in, so they got to finish it. But a lot of times, if they're building a home and they thought that they could get $300,000 for it and they can only get $270,000, that's called impaired. As soon as you have a piece of land that you know that you put the house up and you lose money on, then they have to write down their book. So that's what you want to watch. You want to watch whether they're still building and whether they've gotten rid of homes and how much they're impaired. Because every time there's an impairment, the book gets dinged. It's great that they have the cash flow. That's very important.
Okay, thanks a lot, Jim Cramer, on Home Builders and today's recent earnings reports from Toll Brothers. I'm Farnoosh Torabi. This is Wall Street Confidential.